Hello again, everyone. Welcome to the May edition of the Real Estate Edition podcast. My name is David Bastel, joined by AREA President Sean Morrison. Sean and I continue to social distance ourselves here via Zoom. And Sean, it is so good to see you today.
It's great to see you too, David, and great to be back here for our members talking about something that we deal with every day, and that's we're going to be talking about mortgages.
Yeah, absolutely. Our guest today is Mr. Albert Colu. He is the former president of M3 and current CEO of CO5 Consulting Group. He brought a lot to the table considering mortgages, rates, everything to do with it, and a lot of people in our membership asking a lot of the same questions, and that's why we brought Mr. Colu to the table today.
Absolutely. I mean, he's going to be chatting with us today about what to do if your client is laid off by COVID-19. Will they still qualify for their mortgage at closing? And also, what questions should you be asking a mortgage broker? So there's a lot of good content in this episode for our members.
Tons of questions for our special guest joining us now. Have yourself a listen.
You're listening to this month's episode of The Real Estate Edition with host Dave Bastel and AREA President Sean Morrison.
Albert, thanks for joining us. Can you tell our listeners a little something about yourself? I understand that you're also starting a brand new position.
Yeah, it'd be my pleasure. So from a 30,000 foot level, I played a senior role with two of the larger institutions in Canada. And then from there, I migrated to the mortgage broker channel distribution side of the ledger, where I spent a number of years as a CEO and president of some of the largest brands in Canada. And to your point, David, I just took on a position with a group that I'm really excited about. It's called the CO5 Consulting Group, and it allows me to do all those great things I've been dying to do.
Now, Albert, as you can imagine, we're receiving a lot of questions from our members about mortgages and how everything's being impacted because of COVID-19. One of the most common questions is what happens if people no longer qualify for their mortgage at closing now that they're laid off due to COVID-19. Can you share that with our listeners?
Yeah, thanks, Sean. That is actually one of the biggest burning questions out there right now, and there's some good news around that. So there's a couple of things here that are really important. The first thing is, in terms of the lender or the bank that is financing the loan, they all have independent situations. But what I can tell you from experience here is that a lot of the lenders are actually very understanding of the situation at hand. So that's all to say very clearly that banks and lenders are not generally walking away from deals when we have situations where borrowers are temporarily laid off due to the COVID situation. A little more granular, Sean, to that is the entire qualification process still allows a retooling or a reassessment by virtue of seeing who else is on these mortgage applications to see if that carries the weight in terms of servicing the loan. But I think generally speaking, the audience should take some solace in knowing that the lenders and banks and insurers at large have been extremely good. I have never seen actually such a coordinated effort in all my years.
Well, that's really great to hear. So the message, the high level message to our members is that banks are willing to work with people as to the closing of their properties so that they can still get those closed and not suffer any hardships as a result.
Absolutely.
Excellent.
Just to follow up on that, Albert, if people are having problems, what's the first step they do in that situation? Do they call their broker? Do they call the bank? How does that exactly work? Almost to take it down to a ground level.
Yeah, so it's a great question too, David. You know, the reality is if borrowers are dealing with mortgage brokers per se, then yes, absolutely, they should reach out to the mortgage broker immediately, and then he or she can take on the activity of connecting with the lender. If a client is working with the bank directly, the same exercise. So there's no shortage of understanding right now from the supply side, but the definite starting point is the original person you started to ignite the application with.
Gotcha. Can you share some insights on the cost of a mortgage deferral and whether or not it actually is more expensive? Can you break that down for us?
Yeah, that's another question. I've seen all sorts of posts and media out there talking about the deferral program leading to interest on interest. And, you know, that is true to some degree, David. Really what the deferral allows the client to do is to put off their mortgage payments for, depending on the lender, 3, 4, 5, 6 months. But what consumers are not being clear on is you may defer the principal payment, but the interest accrued over that particular point in time is still going to be added to the mortgage. So if you've taken your mortgage deferral for 6 months, and just for the sake of easy numbers, if interest is $1,000 per month, that $6,000 that accumulated over that period will be attached to the mortgage.
And when does that actually get attached? At the very end of the actual 5-year plan or 4-year plan, or whatever amount of time you're locked into it?
Well, in essence, in simpler terms, it actually just attaches that interest amount to the principal amount. So,
Okay.
for lack of a better comparison, when we go into a furniture store, they say, listen, you can buy a couch, but you don't have to pay for 2 years. The couch is $500. You finally get your first statement. It's like $900 for a $500 couch. Same idea.
Gotcha.
Now, Albert, a question in regards to, for our members, what are your thoughts on the mortgage market in general right now? If you're renewing, for instance, in the next 6 months, what should you be doing? Should you be fixed or variable? Does it matter? What are your thoughts on that?
Yeah, well, I think it does matter. I mean, the first thing is, if COVID aside, anybody taking on a mortgage that's a variable should have a larger risk appetite, because those payments can certainly fluctuate, as I think most people know. From a personal perspective, because there's so much uncertainty right now that's guiding the market, particularly where the fixed rates are, it might be a wiser decision for consumers to get into a period of time in which they've got some certainty. So I would say fixed rates are probably the more appropriate.
And since we're on the topic of rates, do you see them going up or down or remaining fairly steady over the time? I mean, I'm going to ask you to pull out your crystal ball a little bit here.
Yeah, that is a question that we're all trying to handle, whether you're in capital markets, whether you're an economist, or at my roles. The reality is this. So, if I may, Sean, here's a couple of quick things that we get thrown our way. Is, why is the overnight lending rate or all these Bank of Canada relief exercise not being reflected in fixed rates, because there's such a gap right now? So what I would say is that the rates are not going to be dramatically altered in the short term. I think we can all understand why. But if people are out there wondering, well, why is the fixed rate seem a little bit higher than I think it should be? Really, in simplest terms, it's the market's way of signaling that they have to cushion in some unforeseen risk, because I'll tell you, it's very gray out there right now in terms of any risk modeling.
Yeah, it certainly is. Albert, I've received a couple different emails on this, because we sent out
Sure.
questions from, just to let people know that you were actually going to be on this episode. When you look at rates itself and talking about the 2020 season, using the example as, say, December, once this market heats back up, does it heat up fast in the winter months, or does it gradually make its way up to what we were percentage wise for mortgage percent rates in, say, December of 2019 or January of 2020?
So we're talking post-pandemic, for lack of a better phrase, David?
Well, that's what the hope is, crossing our fingers that we actually are in that kind of situation, say Christmas time.
Well, here's what I think will happen as I'm watching this very closely. We're already starting to see signals in the market based on the assumption that they're going to start relaxing the social distancing. More specifically, you take a look at the stock markets, the slight increase in the Canadian dollar. We're starting to see that what might happen is that the demand is not going to be gradual. I believe it's going to be sharper. I think if we look back before the second week of March, when we really went into quote unquote this COVID situation, the markets were incredible. I mean, your listeners will know that better than anybody. The markets were very, very warm. In fact, the strength of January and February and early March is what has carried most of the supply side right now in terms of fundings. So I believe that once Canadians are confident, they're going to start getting back into the markets. I think they're going to go to restaurants and order everything on the menu, and they're going to get right back into action. So what that is all to signal, David, is that the typical seasonality we have seen in our industry is we will underwrite, or we'll see home purchases really take hold in March, April, and May. And then June, July, August, everyone closes those loans. I think, to your point, I think what we'll see is a really abnormal Q3 and Q4 that will resemble a lot like what June and July and August might have.
Now, talking about people getting ready to jump back into the market post COVID-19, or in the new reality that we find ourselves in, do you have any advice for our listeners in regards to talking to a mortgage broker, what questions to ask so that they make sure that they're working with someone that their client can feel comfortable with?
Now that's a great question. I think the first thing that consumers are probably very responsible for asking at this point is, how much flexibility do I have within this mortgage product, just in case something nefarious should happen? I lose my job, there's an economic downturn, all those things. I think that the market has been conditioned very poorly in that we've got consumers focused in on rate. And that is probably not the focal point, because I think what most Canadians need to understand is, even if you have a mortgage rate that is 10 basis points less for a mortgage of, let's say, 300,000. So more specifically, you have a mortgage that's 309 or 299. The 299 certainly looks attractive, but people forget that 299 to 309 only represents about $15 a month. So I would say flexibility for sure. And the other thing is a little bit more altruistic. I think if this market has shown the Canadian marketplace anything, is that maybe Canadians need to be a little less up against the wall when it comes to mortgaging themselves. That term mortgage broker is starting to emerge again, because we are now approaching, give or take, almost 1 million Canadians that are opting for the deferral program. That should tell us something.
We will be back after this short break.
Join the AREA Realtor research community to have your say when it comes to the services AREA provides, the recommendations we make to the government, and the strategic priorities of the association. You'll receive exclusive content and be entered into monthly draws every time you complete a survey. Visit joinarearesearch.com to sign up and join an exclusive community of realtors making a difference. joinarearesearch.com.
Albert, when we're talking about the real estate market itself, you kind of touched on it with an earlier question, and you know what the hope is, fall, winter, everything will heat back up. This last month there was a tremendous downfall as far as the percentage of real estate, which is very, very excusable considering what the world is under right now. When things do get heated back up, does it fire up immediately as far as the real estate market is concerned, or are people going to be reluctant to make that sort of purchase? It's one thing to go to restaurants and do the fun things that we like to do socially as people of this planet, for lack of better words, but to actually make that purchase of the biggest purchase in most families' lives.
I think it's actually two buckets, David. I think the first one is for those borrowers or buyers that have been steady in their income and steady in their job through this, are going to be out there and they're going to be going hot and wild as far as I'm concerned. We're starting to see evidence of that right now. However, in the second bucket, if you are one of those borrowers that has incurred a temporary layoff, until such time as they resume their jobs and their incomes are streaming in again, so to speak, I think there'll be a little delay. But I do think that the market will be a lot warmer out of the gates once we get the green flag from the government to start being a little bit more loose with the restrictions or whatever have you. I mean, look, not to get a little bit off track, but if you take a look, even yesterday when the premier had announced, he didn't announce, but he intimated pretty clearly that by May 19th, they're going to start relaxing parameters so that business can start to open up a little bit more, but more specifically, cottagers can go enjoy the lake and the boats. There's no doubt in my mind that's going to spur on confidence.
Now, in regards to new builds versus resale, is there any difference in looking at that post-COVID-19 coming out of this, from your opinion? Is it going to be more strict when it comes to a new build that might not be ready for a year or two, or is it going to go along the same lines as traditional lending as it has in the past?
I think the lending will be relatively the same, Sean. I think the biggest concern for people buying new builds, whether they're condos or homes, is they have to take a look at how has their closing date been disaffected. If this pandemic goes on for 6-7 months, it's reasonable to think that the construction or the closing date may slide with that. And that could be a problem for people who have maybe a buyer in the wakes for their existing home. But I would just say be very, very aware of really stretched out closing dates, which, as we all know, that happens anyway before the COVID, but this could be exasperating.
That's a really good point for our members to keep aware of. is that due to COVID, with resale or new construction, there may be delays in closing, and to have that conversation with their clients. That's sage advice.
Thank you.
Additional stuff, Albert, as far as what we haven't touched on, and what you've kind of experienced over the last, I guess we're very close to week number 9 of this, almost a 10th week of the stay-at-home policies and so forth. Is there anything else that kind of hits your radar that we haven't touched on that people should know about?
Well, I think specific to your listeners, David, there's one point right away that I'm sure they're all aware of, which is the nice hidden surprise in all this is that even though that the activity is down, 67, 68%, I'm really happy to see that the valuations of those homes are still standing pat. So that's a good signal. Number two, with the real estate agents listening in and real estate brokers, they may wonder how is the transaction actually going to manifest itself in terms of literally the logistics of the process. And one of the things that the realtors may not be seeing is that the supply side has made some radical changes to help with the process. So more specifically, if a real estate agent's listening in wondering, geez, I can really sell this house, but I can't get the buyer to get an appraisal done because of obvious reasons, they should know that no longer exists. There have been several adjustments that allow to modify the appraisal process so that the transactions aren't impeded. So there's a lot of things out there.
Yeah, and I mean, that's a fair point with the appraisals. I hear from members a lot, what happens if the appraisal comes in low now because of COVID-19? I know you had touched on that the valuation is staying strong, which we have seen as well in the data that we've been looking at. But is there a chance of the appraisal coming in low because they might just be doing a drive-by appraisal as opposed to going in the home? And if so, what can members do to help their clients in that situation?
Yeah, that's a good question. It's interesting because that's always a risk, regardless of the COVID situation. Appraisals, they're a funny thing at times, right? What I would say now is if we come out of this sooner than later, Sean, I don't think there's going to be too much risk of having valuations coming in lower if it's priced accordingly right from the outset. But I would say that it's reasonable to think that if the pandemic continues to go on for an elongated period of time, then yeah, there is going to be a buffer in there in terms of valuation processing. But as you already alluded to, so far so good. Firsthand experience is showing that those valuations are there. And by the way, I mean, maybe I'm just stating the obvious for your constituents, but the value is sort of a red herring because if no one's buying at the moment, the valuations kind of stand pat as it is.
Yeah, it certainly does. Albert, just kind of reviewing here quickly, we talked about a little bit off the top here as far as the market is concerned, renewing in the next 6 months. It's all about rate and what the customer feels more comfortable with at the fixed or the variable mortgage. And it's almost, a person-to-person, evaluation of what works well for that client at that time.
Yeah, absolutely. I mean, it's particularly with variable rates. So right now, those particular mortgages could look very enticing because we have to take a look at the obvious, which is that overnight lending rate has been changed dramatically in the last 2-3 months, which has brought down the prime rate. So, a consumer may say, geez, that's a really attractive opportunity. But here's the thing. You were asking me about rates earlier.
Yeah.
Basic economics would suggest that the one thing that will rise far faster than the fixed rate will be that prime rate, specifically those variable rates. So that's why I was suggesting earlier, if you're looking for a little stability with a still a very, very awesome payment, fixed rate's probably the most conducive for most Canadians right now.
So, Albert, would you then advise our members, if people are looking at getting into the market soon, to go out and get that pre-approval done now, lock in that rate just in case that fixed rate starts to rise?
I would absolutely recommend that. I would go one step further to be certain that where possible, stress test yourself. I know that the federal government is putting, quote unquote, stress tests, but if you're a 2-income home, take the rose-colored glasses off and really see what would happen if one of the participants in the household would lose their job. I think it would be a responsible exercise at this point in time.
No, that's sage advice for sure.
Just so we know, I know a lot of the clients probably do know this answer, but for everybody that doesn't know the answer, if a mortgage is up for renewal at a certain time, what's the earliest a person, a family, could actually lock in a price?
Yeah, so there's another great question. So it's interesting because most lenders, whether it's a bank or just a monoline lender, will reach out to a client of their own accord, usually about 6 months out. The banks tend to be maybe a little bit more like 90 or 120 days out. So it's actually quite an easy process, David, as most of us have had our own mortgages renew. As the client draws nearer to the maturity time, they'll automatically get a documentation or a package through email or mail to simply just renew without having to go through a lot of laborious requalifications, unless of course they want to add more money to this principal amount. But off the shelf, it'll be pretty easy.
Yeah, because I received, I guess, an email about this earlier that a friend of mine actually is up for renewal in March. And he was sitting there telling me, man, I wish I could lock in a price right now here in the month of May. And I'm like, well, you know what? I'll ask the specialist that we're talking to, but I'm pretty sure that you cannot do it 11 months in advance. Although some of us in that situation, if we're in this family situation, we would probably like to do that.
Well, sorry, then let me refine my answer. So what I described was the typical renewal process if the client doesn't want to do something before then. Now, in the case of your friend, this actually just becomes a simple function of math. So your friend's going to be subject to an interest payment, of course, or a penalty. So the math would be very easy. What's the cost opportunity of breaking it today? So whether it's a refinance or an early renewal. Your friend has that opportunity to do that. There's no question about it. Just he or she's got to make a decision in terms of whether or not the math lines up for them.
I see. So whatever percentage they locked in at when they actually locked in the mortgage, I guess almost 4 or 5 years ago, whatever it would be. I think it's a 5-year term, which is probably pretty standard. You'd have to figure out, is it worth breaking to secure yourself whatever that current fixed rate is or the variable rate, depending on where they want to go with it.
Yeah, absolutely.
Now, but I just want to circle around to stimulus packages from the government. Are you finding in the field that there is a higher rate of default on mortgages due to COVID-19, or have the measures that the government have put in with deferrals and that are working in this case?
Well, the good news is there are no real defaults to speak of because those government subsidies are coupled with the deferrals have insulated everybody against that. So if you're in a situation like we talked about earlier, Sean, like this, you've been temporarily laid off, that mortgage is not technically in arrears because the client and the lender have accepted that they're putting off payments for X amount of time. So the arrears right now, there are no nightmares on the horizon. But we'll let the next 4 or 5 months play out, and we'll see if that becomes more real.
No, absolutely. It'll be good for our members to know nobody's going to be doing what they did in the 90s, which is just kind of dropping keys on everybody's desk and walking away.
Yeah.
Albert, just finishing up our interview here, and thanks again for joining us. Really appreciate your time. How has the last 8 to 9 weeks been with you personally and your family? We trust everybody has been healthy in the household.
They have been. Thank you for that. Yeah, we've been keeping busy. We're keeping well. You do get a little stir crazy to some degree, but it's been a great time. And on a personal level, timing's weird at times, but I just left an incredible post with an incredible company where it was overseeing a very large organization to pursue something different. So I started a company I mentioned earlier called CO5 Consulting Group. I was a little nervous about that, but it's turned out to be phenomenal. I guess people are looking for sound business advice, I guess when it counts most. So I'm excited about that for sure. And by the way, David, Sean, it's been my pleasure actually to be here for you and your listeners. And at any time, I'm always available to this crowd.
No, we greatly appreciate that and glad to hear everybody's healthy and safe in your household. And we hope in our membership as well.
Thanks, Albert.
Thank you.
Some excellent tips from our guest, Albert, who joined us on this episode of the Real Estate Edition. Be sure to subscribe to the Real Estate Edition podcast wherever you listen to your favorite podcasts. And for all information on COVID-19 and real estate in Ontario, log on to www.areacovid19info.com. That wraps up this episode of the podcast. For Sean Morrison, I'm David Bastel. Talk to you again next time.
Visit aria.com/podcast for more information, links, and a full list of our episodes to date. New episodes are out the second Tuesday of every month.